Welcome back to our special analysis of the Economic Survey Part 2, or midterm review, if you please. The three main questions that the survey has raised is, one, is it going to be difficult to achieve fiscal targets because of farm loan waivers and because of the growth scenario? Two, whether economic growth itself is going to be a little lower than several floating forecasts, which are between 7.3 and 7.5. And third, whether there is a structural shift in inflation and therefore the Reserve Bank has more space. Well, let me come to the issue of farm loan waivers. Sajid, the argument of the survey is that because there is farm loan waiver, the Reserve Bank should not assume higher inflation. On the contrary, it will be a contraction of demand. How is that explained?
So I think, just stepping back, Lata, the survey has a great analytical depth and rigor and a must-read for everybody. It makes a very interesting point here that just when we look at the central government fiscal deficit, we net out asset sales and bank recapitalization to compute the actual fiscal impulse. What the survey says is when looking at state finances, to the extent that states have a hard budget constraint of 3%, and to the extent that some of these states have come up against that, the more farm loan waivers there are, the more states will have to cut either expenditure or raise taxes to be able to finance the farm loan waiver. And what the survey says is that we then, to understand the impact on aggregate demand, one has to look at the elasticity of higher consumption by farmers in the event of a farm loan waiver and trade that off against the higher elasticity of lost spending or taxes that states have to undertake. So it's a very interesting and important argument, I think, that the conventional wisdom may not be correct. But I would simply offset that by saying over the last 3 or 4 years, I'm a little bit wary about arguing that states are going to be prudent. Given the history of the last 3-4 years, you've seen state deficits widen very much. Mm-hmm. And so even while the survey is right that the 5 or 6 states with debt waivers may actually have to cut other expenditure and reduce their demand, it's also equally true that there are many other states who are below the 3% limit who may actually increase their fiscal deficit. So what the consolidated fiscal deficit is at the state level, X loan waivers could go either way. One other point I'll make is I think generally, apart from this issue, fiscal risks have clearly risen for states in the next 2 years. They've got their pay commissions. Yes. They're struggling on the revenue side, both with lower stamp duties and alcohol revenue realizations. So I think the state picture is far more complicated, and I think there are a lot of risks there. But the survey makes an interesting point on how we should think about the impacts of debt waiver on aggregate demand. I'm inclined to agree with the state simply because I know several of my own relatives. There are times when the states don't pay teachers' salaries because they have to meet deficit. It is a fairly hard target. The way fiscal deficit for states is implemented, they had to beg their way out when Uday reforms were implemented and the DISCOM loans became a part of state government loans. So there may be some truth in what the survey is saying. Soumya, the other question I wanted to ask you is that the survey takes for granted that India is in a new normal with respect to macros in general, current account deficit under control, simply because oil is going to not be an issue, and agricultural productivity and the way in which minimum support prices and marketing is being organized, or the GST and the tax trail that governments have. All this have set a new normal for macros. Do you agree that those macros are actually positive?
No, I tend to agree with the fact that India is actually in the new, the macro narrative is actually far better than what we was witnessing in the last 3 years. And it's a good thing that we have built a large part of it, specifically the fiscal consolidation part. Against market pressures, the way the fiscal deficit has been consolidated, the external sector numbers look quite decent. The inflation has structurally corrected from 11% to around 4%, that too on a consistent basis. And also the fact that, there has been, if you look into the other numbers, apart from the real sector activity, I think most of the other numbers are looking much better than what it was last 3 years. But that doesn't mean that we should be complacent enough. I think there are still some signals, for example, like the farm loan waiver. Then there is also the fact that the growth is not picking up. There is an issue a little bit stressed on the fiscal side, given that the numbers from the RBI dividend payment has nearly halved.
Yes.
So I think we should not sit complacent, and there are some dangers, some lurking dangers, at least in terms of the fiscal path and also in terms of an overvalued exchange rate, which we should be a little wary with in the coming days.
Okay. Well, actually, in the first part of in the first chapter, there isn't much discussion of overvaluation of the currency. Yes, that definitely remains a challenge to exports as well as to domestic industry. Final question to you, Siddharth. Are you convinced of the argument that there is more space for the Reserve Bank? And should the Reserve Bank were to oblige with another cut, does that really solve the growth problem?
Well, I would rather tend to be a little more conservative here. I think going by our traditional framework, where inflation used to be slightly higher than what we are seeing now, the current 6% range of repo rate is kind of the lower end of the spectrum of the usual habitat for repo rate. So from that point onwards, whether the Reserve Bank cuts more, now we are not discussing about one more cut or something like that now. Structurally, whether there is room for considerable space, as the Eco Survey has kindly, pointed out. So if that is the argument, I would rather expect the Reserve Bank to be going very slow at this point of time. They would like to be 200% sure about that particular scenario rather than jumping guns and offering significant cuts at this stage.
Very quickly, all three of you, please try and give me monosyllabic answers. Do you think that for this year, perhaps the macros are not in alignment for a 7% plus growth, but the economy can rebound very sharply in 2019 because the macros are in place? 2018, 7% plus?
We are quite positive about the economy for over a 3 to 5 year kind of a horizon. 7
this
to 8%
year, 7%?
Plus. 7% plus.
Okay. Sajid, this year, 7%?
Well, let me just say very high marks on macro stability, which is the #1 priority. I think this year and next year possibly just about 7 to have a more sustainable recovery, much higher than 7. We'll have to wait, I think, at least 2 or 3 years.
Okay. Soumya?
No, I think this year could be a little bit difficult to be a decent number, but I am hopeful that the recovery will be faster enough once we settle down into the new normal post GST and demonetization.
All right, then I don't see my panel disagreeing seriously with the survey's forecast, except perhaps Siddharth, who thinks that growth is not going to be impacted. Otherwise, there are dangers to growth, but because the macros are so much in place, perhaps we are going to fire away much better in the subsequent years. Maybe this year is going to be tough. That's the conclusion of the survey, and that's the conclusion of a majority of our panel as well. We wrap up our special show on the economic survey. Thank you very much for watching.